All right, in today's video, we're going to be talking about, does infinite banking make sense if you're not able to put in big premium dollars? I'm here with Austin Williams, and man, I'm excited about this because one of the number one comments that we get is, Caleb, you're using examples like 20,000 or 50,000 or dump-ins of 100,000. Love that, but what about me? Does this make sense if I'm only putting in a few $100s a month? And I'm really grateful that we're taking time to make this video, and grateful for you, Austin, in Austin fashion, put a whole presentation together with real numbers. So if you are excited to learn, like, you better dive in, like this is going to be the video for you. And I just want to set the stage. We all have to start somewhere. And when I first learned about the power of life insurance, I gave myself the ability to start with a few $100 a month. And I still have that policy to this day. And I have fond memories. And that was like the gateway drug, you could say it that way. That was like the door opener for me to really go down the rabbit hole. And so I know that there's many people out here that want to start something, but know that this is just the beginning. And so without further ado, Austin Williams, one of our coaches, and man, now you're a YouTube star. So welcome back, and I look forward to diving in.
Well, thanks for having me, Caleb, and I'm glad that I could bring this content to you. You call it a gateway drug. I think people nowadays, one gateway drug people talk about is like backyard chickens. How that's like a gateway into like kind of all things crunchy.
Conspiracy theories.
Conspiracy theories, right?
Chickens,
so yeah, that's right.
Like
so
the gateway to every conspiracy known to man. So I love it.
That's right. Basically, yeah. So if you start questioning your food system and get your own chickens, like everything else falls like dominoes. So this can be like your backyard chickens, right?
Yeah,
this is going to be the gateway to you and your in a financial future where you kind of take control into your own hands. And this can be where it starts, small but mighty. I really like that title, by the way. I came up with that myself.
All right, so let's tee this thing off, and I'm going to let you take it from here, and then I'll pipe in as we go through the presentation.
Very great. So as you see, number one question that I've got of content people wished that they've seen so far but haven't is, can I do everything that I see but just not 30,000 a year? And so I was like, I need to put something together for like 10,000, because we have helped many clients over the years. Before I was here, and definitely since that I was here, get these size policies. So this is you're not an outlier. That a lot of people have gotten a lot of value from policies exactly like this. And I've even made smaller policies than this that people get a lot of value from. But I want you to know that 10,000 a year, that's 800 a month or so. You absolutely can do this. And so let's go a little bit more into that right now. So yeah, as I said, the single most requested piece of content that I've been asked for. Let's talk a little bit about like what came before this, right? So, before like kind of the max funded, kind of overfunded style policies, what does the traditional case design look like? Okay, well, great question. So, the average person is older, right? Maybe in their 40s or their 50s. And if you're in your 40s and your 50s, on average, you're going to be a little bit more established in your career, generous cash flow. Your kids are grown. Maybe they're out of the house. Maybe they're about to move out of the house. And what's on your mind is not necessarily maybe so much the day to day. Like maybe you kind of have your routines down, your financial routines, your traditions, but you're kind of more so thinking about the future and about legacy. So, when you're coming in to get your life insurance, you're more so thinking about the death benefit, because you're thinking about your estate. So it's death benefit focused rather than cash value focused. Legacy is a primary concern. If you think of a pyramid, there's like the retirement planning pyramid. One side is the accumulation side, and then the other side is the distribution side. In this scenario, the traditional kind of way to do life insurance, it's a distribution side asset, right?
Yep.
Right. So where it's not necessarily helping be an asset that you can help you save for the future. It's an asset that's going to kind of take care of you as you're coming down the mountain.
Yes.
And I know, Caleb, that this was in the space when you began. You
Totally.
Probably sat down with a lot of clients who came in wanting this, and you wrote it for them because that's what they wanted. Yep. There's nothing necessarily wrong with this if that's exactly what you want.
Yep.
Do you want to talk a little bit about that?
I think the traditional retirement planning world is you put money aside into different accounts. Over time, those accounts will grow in value and benefit. And then you hit a time where you don't have to work, you hit retirement, and then you spend down that money. And a very common pitch of life insurance to this day, I think we're in a bubble because we're talking all about high cash value policies and entrepreneur, like people using their life insurance throughout their life. Like that's still very uncommon when you think about it. And so one of the things that most people will sell insurance on is just like, hey, 30 or 40 years from now, you will thank me. And they're not wrong. You're going to show in your example that over 30 years, the policy that you show that's a typical case design, over a long period of time, you can totally say like, this is pretty good. But then the question is, can we make it better in the short term and long term? And when you know that, it's going back to the chickens. When you know that, it's hard to go back. And that's where where this whole deal is. Like traditionally, it would be hard for someone that didn't have a ton of money to really buy into like insurance as an asset class. And that's why in the past or right now, like people like Dave Ramsey and others will say life insurance is a terrible place to put your money because they're comparing it to an accumulation distribution side. And they're like, this underperforms what you could do in the market. And so all that to say, I see the benefits of insurance sold that way, but it's hard to get behind. And even like we wouldn't be building this business the way that we're building if this was the message that we were trying to get behind.
Absolutely right. Yeah, it's right for the right kind of person. Definitely not generally our audience. We've helped people who have this need before, but generally, people like it because the way like the and asset, because it's the and asset. It's not the either or asset. It's not the once you have enough asset. It's the and asset. So let's look at like just some numbers here right now. So this is a traditional case design policy. So on the left hand side, you'll see over here. In these two columns here, you see this one, the base contract premium, that's buying the minimum amount of death benefit needed to keep the policy active. This right here is a term rider, which is inflating the death benefit at minimal cost. And in this policy, that's about $8,000. So out of that 10,000 number, about 8,000 or 80% is going to base. And impressively, and this is actually better than a lot of traditional design products, there's still about 20% PUAs. So there is still a little bit of cash value accumulation. As you see right here, this is the total premium, 10,000 going in a year, every year for the next 30 years. And then over here, we're going to look at the non-guaranteed side. So in the non-guaranteed side, two columns we're going to kind of focus on. There's the total cash value and the total death benefit. Now, as you put money into the policy, the death benefit increases and so does the cash value. And you'll notice as you put in dollars over here, that they also show up over here. So the cash value is the amount that's available for you to borrow against before you die. And by year 10, you'll notice that if you can do the math in your head, 10,000 times 10 is 100,000. And there's this number right here in the cash value that is over 100,000, which means that this is the break-even year. So in this traditionally designed policy, in year 10, there is more dollars that you can borrow against than you've personally contributed. And this is not the way that we would generally design policies that are infinite banking design. However, this client who's kind of in for a traditional policy doesn't really care about this. This isn't really important to them, so this doesn't really matter. They don't really care that it breaks even in year 10. Yep. For them, their death benefit starts at 543. Something I forgot to mention in the beginning. We'll look back over to the left-hand side. This person is 48 years old. I should have mentioned that at the beginning, but 48 years old, so they're up there, they're not at retirement yet, but they're definitely thinking about it. And as you get older, the more and the older that you get, obviously the more expensive insurance gets. And so these numbers are very specific to somebody of that age. Yep. The death benefit here is starting at about 500,000. And then as it goes down, as you see all the way down to year 30, it's 766,000. Yep. So you get about a $200,000 gain in death benefit. And then by year 30, assuming once again that you have contributed exactly the way this is represented and that the dividends pay out exactly as it's represented here, the cash value has gone from 4,800 in year 1 to about 557,000 here in year 30. So, pretty good, kind of traditional, still has a little bit of, paid up additions in it, but ultimately a death benefit focused policy. Yep. Any thoughts on that, Caleb?
Couple thoughts. So number one, we talk about flexibility. It's a little bit flexible, but not super flexible. You have to pay around 8 grand a year in this scenario. And I do want to know, after year 2, you could use some of that cash value for some of that flexibility if you didn't fully leverage it. So in a traditional way, if they're not quote unquote infinite banking their life insurance, this thing would be totally fine after a few years from a flexibility standpoint. But that's one thing to note. The other thing to note is with this carrier that we're using, we're giving you a traditional design, but it's still a pretty great, like most traditional design policies would not break even at year 10. So I want you to know, like, this is on the good side. And I think the way that you design this, you could design it a lot worse, and you're giving this a benefit of the doubt. The other thing that I want to note is it has grown in death benefit a little over 200,000 over 30 years. That's something important to note, because in the next example we look at, that we might see a little bit different example there.
Yes,
and so overall, this would be like if someone came to us and they've already had this policy for many years, this is they should keep the policy. Like this is, you're putting money in, it's being efficient. It's not a bad policy. But again, like you'll see changing a few things with this contract, make this thing a totally different outlook. And I think make, especially someone that wants a small but mighty policy, gives them so many more advantages. And so anything that you want to say before we drum roll and go to the next?
Absolutely not. I think you took the words right out of my mouth. Let's head to the next one. So SBM, small but mighty case design. So what is, and these are the kind of the questions I'm always asking myself as our clients call us, is like, what is this, what is going to help this person get closer to their goals? And so if I'm thinking about a small but mighty design, I'm kind of looking for a few things. Right, so they're young, right? They're maybe in their 20s or 30s. They're just kind of starting on their financial journey, right? Their cash flow is probably even pretty lean, right? Like they don't have a lot that they can kind of afford to reallocate, but they have some, right? They're not broke, they're not destitute, they're not just scrounging for food, trying to find it on the streets or in unused cupboards in their house. Like they have a little bit. They're usually also just starting a family, or maybe they even want to start a family eventually. I've had people fall on either side of this, young families, or they're like, you know what, I don't have anyone, I'm not married right now or have kids right now, but I want to have those things. And so I want to have this kind of already in process by the time that time comes. They might also not know exactly what income producing activity they want to invest in the future. Now, I want to be very clear here. Life insurance is not an investment. Don't sue us. Don't say that we said that. This is a liquid savings vehicle, and you can borrow against the cash value, and you can use that to put into some other investment. But the life insurance itself is not the investment. So I often ask people like, okay, do you know an income producing activity that you want to invest into? And the people who tend to fall in kind of the SBM sort of category, the small but mighty category, like they generally don't know. Like maybe they want to do, maybe they say maybe real estate, or maybe hard money lending or something like that, but they don't really know. But they want the opportunity fund.
Yes.
Right? Like they would like to have that available so that in the future, if an opportunity arises, they can pivot on a dime and they can jump on it.
And can I say something here?
Yeah.
The small but mighty case design, one of the default investments that they should be thinking about is investing in themselves, in their ability to create more value and their ability to make more. That is like I'm not saying that that's across the board. Some people might be in this and they're ready to do their first real estate deal and all, but I think one of my advice that nobody asked for is, if you're in this stage, try to create value that's tied to you, because that usually is where the best returns are going to be. You will get to a point where you're going to be tapped out on that. But early on, the idea should be like, what can I do such by doing creates, more cash. And the small but mighty policy might give you the ability to have capital to be able to say yes to something that maybe if you were doing a different financial strategy, you wouldn't have that money to invest in making yourself more valuable. And so that is just something, a mindset to have when you're thinking about this is, it is okay if there's nothing that comes to your mind. Think about yourself first and foremost and ask, like, what could I do such by doing that would make me more valuable to the marketplace?
Absolutely. Could not agree with that more. Yeah. Because if you choose like more of a traditional investment, you have to give your money to someone else to essentially take care of it. And then you don't have access to it, while it's with them kind of earning whatever sort of rate of return it's earning. So this is nice that like, you're giving it to somebody else, but you still have access to it at the same time, which is awesome. And then lastly, you want something, this the average person, like, they probably will even have, or at least that they could benefit from term insurance alongside this permanent insurance. They want something permanent to outlive their term insurance. But ultimately, at first, permanent insurance, the death benefit starts low. So they're content, though, for a while for just kind of letting that build up, because these small but mighty policies, as you'll see, death benefit starts low, but over 30 years, it gets huge, right? Absolutely huge.
Okay, drum roll, please.
Right, so here we go. That's right. This is the kind of policy, if you kind of fit into those categories we just talked about, that I would build for you. So the first thing you'll notice is that this is not the same age client. So as I had mentioned before, the client that would fit into more of that kind of traditional policy was more that in that 48-year-old range, right? So like the late 40s, maybe 50s. Mm-hmm. And then this is much younger. So, they're 24 years old, 25 in insurance age. And so much younger. But the benefit now is that because you're much younger, the cost of insurance is also much cheaper. So because of that, and also because of the way that we design policies, we're not going to make this like an 80-20 policy. We're actually going to kind of flip that. So same two columns you see here: base contract premium, buying the minimum amount of death benefit needed to keep the policy active, and then the FPR contract premium, the term rider. These two numbers together are not 8,000; they're 1,800.
Wow.
All right, that's pretty cool, right? So instead of it you needing to having a mandatory 8,000 a year, it's only 1,800 a year. And the difference there is in the paid up additions. This column over here. So as you see, that 8,200, right? So that number, that's optional, right? So you can contribute it or not. Mm-hmm. But that just gives you a lot of flexibility that traditional policy would not have given you. All right. So same amount of money too. Let's see, 10,000 a year. Absolutely identical policy in terms of the amount, the actual dollars that are being contributed to this. But the base is much lower. The paid up additions are much higher. And because those paid up additions are so much higher as an overall percentage, it's going to have a very big effect on the cash value of the policy and the death benefit of the policy.
I love it.
I love that you love it, Caleb. So we'll go over here to the non-guaranteed column again. So over here, we're going to double click on that total cash value and the total death benefit. So in year one, you remember the first one was like 4,800. It's now 8,300, even though you've contributed the same amount of dollars. And instead of it breaking even in year 10, this one breaks even in year 5. All right. And this is why I wanted to show why you shouldn't be worried, or that you shouldn't be discouraged because you don't have $20,000 or $30,000 to start, is that even if you only have $10,000 a year and that's all you can put for, like, time is on your side. Yeah. And this policy shows like just how more efficient it is if you're starting as a 24-year-old rather than starting as a 48-year-old, right? Like, you can still get ahead and this policy can still do great things for you. All right. So at year 5, 50. So you've put in 50,000 by year 5 of premium contributed, and there is over 50,000 of cash available to borrow against. Now you'll notice, compared with the one that started at 48 years old, that this total death benefit starts at 350 rather than 500. Mm-hmm. So, it's starting lower. And that's why I said that these SBM policies, it's good to have a term policy to kind of make up the difference in the early years. Because let's say you were to die, right, in year 2 or something, right? God forbid. Is that, year 2, you have just around 400,000. And, depending on what your lifestyle is like, how much money you need to cover that might not last for very long. So, but if you had a $600,000, $700,000 term policy on top of that, then guess what? Your family's going to be sitting on $1 million for the first 10, 15, or 20 years, and you're going to be fine. Or at least in year 2, you would get that $1 million payout, and they would be fine. So, and then as time goes on, this is the really cool thing. So you saw in the last policy that, Caleb, that death benefit started at 500 and went to like the mid 7s. Well, once again, time is on your side. This is the benefit of being a young person, is that, it starts at 350, but by year 30, this is at 1.6 million.
Yeah. That's also the benefit of having a PUA paid up additions every year. They're adding to that death benefit total, which is super exciting.
It's amazing. It's like you've contributed the same amount of premium. We've just distributed the dollars and how you're paying the premium into less base, more PUA, and you're younger. And it's like, it's just giving you such a wildly different result that like this, I just want to encourage you, like you can do it. And like this is within your reach. And this could be an asset that gives you peace of mind as you're thinking about, providing for your family and wanting to shepherd your family well and all those sorts of things.
I love it. Couple things I'll just note. Instead of 80% being required in this example, less than 20%. So that's like, it's flexible, more cash value early on, 5-year break even instead of year 10, lower death benefit initially. That's why, and actually Austin and I did a great video on term insurance. Maybe it'll pop up or it'll be in the link down below if you're interested in like what that would look like, because we're a big fan of protection first. So protect your family, give yourself options, but then ultimately it's common for people to have a policy like this and a term policy. And as they make more money, they convert that term, but they keep their family protected at the whole time. Death benefit grows pretty significantly, and the cash value rate of return grows pretty significantly. Because there's just more to compound.
Yeah, there's just more to compound. Yeah. And so as you see, there's that, the last one, the 48-year-old that was more of the traditional one, that had about 550,000 of cash value. And this one has about 688. So over 100,000, about $130,000 of difference between the same amount of funding, but one is starting late and is more traditional, and one is starting early and is just more max funded, small but mighty. It
shows you policy design matter, and then also age matters. And you might be looking at this and might be 60 or 70. Still valid point. Like you can still use strategies like this. You can still fund a policy like this. But the reality is, if the younger that you are, there's just more time. And that shouldn't be a controversial thing. It's just with more time, there's more opportunity. And so, the other thing that I'll just say is, early on, and this is not a dig across the board, it's like if someone is able to save $50,000 to $100,000 a year, they have more money. Like that's a duh, but it gives them opportunities. When you have something like this, you will have, there's this form of like, hey, maybe the first year with $8,000, there might be something that you do, but there might be, there's a world of just putting your head down for a couple of years and we're just building the foundation. But once that foundation is built, hopefully that will create leverage for you to be able to make moves or create more value, make more money. And hopefully every year it gets better and better. That is ultimately our goal with the Small and Mighty, is policy design is every year it's an asset to you, not a liability.
Absolutely. I couldn't have said it better myself, Caleb. Yeah, this policy I think would really, really serve some people well. And I also want to make I'll also make my own caveat here, is that I designed the first policy for an older person, and I did not attempt to kind of max fund it. It was not kind of infinitely designed. And then this policy is designed for a younger person and is infinitely designed. You have to be careful, because not every agent will, if you're young, will just automatically write you a policy like this. Like I could make you a bad policy, or maybe a more traditionally designed policy for a 24-year-old that has, you paying $8,000 a base and $2,000 of PUAs, and that will not perform well. So it's very important that not only for not only just starting young, but also structuring this policy the right way and making sure that you're getting a policy that is going to give you the results that you're looking for.
Yep, love it. Yep. All right, let's move on. Yep. I will also say, if you're watching this video and want to talk to someone on our team or want to learn more about this type of life insurance, we'll have a link down below. There'll probably also be a link if you just want to schedule a time with someone on our team. Austin's incredible. Like, how can we answer your questions? And so those are links below. And then also, if you want to learn more, subscribing, sharing, and commenting on our YouTube channel helps YouTube, tells YouTube that, hey, you're valuing this content. And we'd love to hear from you in the comments on what type of videos that we can do. We're doing this video because of the comments that we've received. And so if there's a video that you want us to make, please share that. So,
absolutely.
All right.
Absolutely. Yep. All right. So, maybe some of these would resonate with you. Some of these SBM style policies I've made, Small but Mighties. People what they've said, it's like playing offense and defense at the same time. Another one, this guy, like he always kept all of his money in his like checking account because it was just like, he was just too worried to let it go. And he's like, this is my first financial step to becoming an adult. And he was like, this is small, but like, this is going to like be like a launching pad into other things that I will do that will just kind of help me towards my financial future. And then another one's like, you actually sat down, you listened to my goals. This is what I can handle. He's like, the other guy that I was talking to, like he was giving me something that was way too big because he didn't sit down and listen to me, but it's the policy that I need. So I think this is the power of these policies. So just to kind of wrap it all up, right? The small but mighty is a low barrier to entry, flexibility, and it can act as an opportunity fund if you want it to. And then lastly, and possibly most importantly, the legacy that it provides, right? So the people who depend on you, the most important people in life, your family, they stand to benefit from this when the ultimate end comes to us all, right? And so some really, really powerful things here to think about, and reasons why I think these 10K policies, $800 a month, they should totally be on your radar.
Amazing. Austin, thank you for taking time to make this happen. We look forward to hearing your thoughts in the comments. And if you're not subscribed to this channel and want to learn more about insurance, make sure to do so. Take care.